start off, I would mark out the buy side liquidity and sell side liquidity, normally using A's in session highs and A's in session lows. In this instance, I saw the equal lows formed in A's in session, so around 7 o'clock. So I decided to mark that out as my sell side liquidity. I marked out my A's in session highs and A's in session lows on the 15-minute time frame. If A's in session was consolidating, however, I would go on the 1 hour and then go for the swing highs and swing lows and use that as my liquidity. Price then immediately swept sell side liquidity at London Open, and then I dropped down to the 5-minute time frame and then marked out my market structure shift, which happened almost immediately after. Then what I go ahead and look for is the first fair value gap that actually formed as soon as the market shift actually happens. And as you can see, price actually taps into the fair value gap, not once, not twice, but 5 times. And funny enough, I actually entered on the 5th time it actually tapped into the fair value gap. So my entry for this trade was actually at this point where it hit the fair value gap, and then I put my stop loss below the fair value gap that was actually below the one that I've actually entered off of, just in case, just as a safety net, just in case price actually decides to disrespect that one and then continue onto that one. Then what I did next is I went down up to my 1 hour time frame, and then I marked out the previous day's highs and used that as my take profit. Prior to this trade, the market was really bullish, so I used the market structure shift as a confluence for a continuation, hence why I marked out the previous day's highs as my take profit. And I got a solid 1 to 3 off of it.